I'm Greg Hunter. Welcome to USAWatchdog.com. The economy is bouncing all over the place. The stock market's down for a few months, back up for a few months. People say it's good. People say it's bad. What is the real story? Well, you have to have somebody on who knows what they're doing. And, in the past, this person has told us exactly what was going to happen. He is none other than Michael Pento of Pento Portfolio Strategies. The economy affects everyone, Michael. Your website, pentoport.com. Thanks for joining us today on USAWatchdog.com.
Thanks so much for having me back on the program, Greg.
The Federal Reserve, listen, I'm not a fan of the Federal Reserve, but, Greenspan, Bernanke, and Yellen sure have loaded up a dung wagon and floated it right towards Jerome Powell. He's acting like he can fix this. Can he fix this?
Well, I mean, the faith in central banks is probably the biggest bubble out there, right behind the bubble in the bond market. I don't know why anybody has faith in these individuals. Janet Yellen told us several years ago that quantitative tightening was going to be like watching paint dry. And then Jerome Powell also said not too long ago, just several months ago, that quantitative tightening, which is the reverse of quantitative easing, is going to be on autopilot. In other words, hey, Wall Street, don't worry about it. We printed trillions of dollars. We took the Fed's balance sheet from 800 billion to 4.5 trillion. And guess what? We're going to take most of that money back and it's going to be fine. But I don't think Wall Street understands until it was too late, until they understood too late the process of quantitative tightening, which is what? Is the process of the Federal Reserve having a bond, a treasury bond, or a note, or a bill, and saying to the Federal Reserve, hey, redeem this, we need the principal back. And the Fed says to that Treasury, we want it now. And then the Treasury says, I don't have any money. So I'm going to go now sell this Treasury asset to the public at a market price. And the money is going to go to the Treasury. And then the Treasury has to send it right back to the Federal Reserve for prompt burning, for prompt destruction. So quantitative tightening is even more pernicious to the economy than raising interest rates. Don't forget
because it destroys money. It
destroys money. That's part of the story. The other part of the story is that the Fed used to own a bond for which the Treasury sold to the Fed at any price. Indiscriminate buyer was the Fed, and the interest went to the Fed and then back to the Treasury. Okay? Now the Treasury is selling a bond to the public at a market price for which the public must be paid a market-based interest, as much as there is a market-based interest any longer, and the proceeds go for prompt burning at the Federal Reserve. So it's very, very destructive to the economy. It's very, very deflationary to the economy. And that's what the market learned in December, October, November, and December of 2018. But either the Federal Reserve was lying to us, lying to investors, just trying to placate them and saying, hey, don't worry about this process. It's not going to be anything to be worried about at all. Or they just ignorant. They just didn't know. But we shouldn't have any faith in these people whatsoever. The Federal Reserve back in 1913 had a very small charter. It was to loan to private banks at a penalty rate. When they were starving for cash and looked to the discount window, they had a little bit of a penalty above the market rate. But that has morphed into something totally different. We have a totally different construct today, Greg. Central banks own the economy. Central banks have become the economy because asset prices have become the economy. So central banks printed $14 to $15 trillion since 2008, since the Great Recession, for the purpose of reigniting and reinflating banks' assets, which were real estate prices and stocks and bonds. That's what they did. And they did it perfectly. But they did it so perfectly that from 2009 to 2014, and then from 2017 to late 2018, the S&P 500 went up 300%. You had a few years there where it didn't do anything at all because before Trump came with his tax stimulus plan. And the fact that the stock market went up 300% was of no consequence to the Fed. They didn't care about that. That wasn't part of their inflation calculus. But what happened was that we had just a few months, October, November, and December, where the stock market dropped by 20% from that 300% advance. And that was enough to get Jerome Powell to panic and then turn from being hawkish. Remember, Jerome Powell said he was going to raise interest rates to 3.5% and drain its balance sheet, another $1 trillion or so. Now it's all pretty much over and done with. Central banks around the world realized that asset prices and the economy have become one, and asset prices are their primary responsibility. And that's what they're there for, to make sure asset prices never go down.
Well, in the pre-interview, you told me that people now realize this is supposed to be temporary. And you're saying that people now realize it's permanent, which is why gold is catching a bid. Could you explain that?
So the whole thing about the Federal Reserve coming out of the Great Recession, not only the Federal Reserve, also the European Central Bank and the Bank of Japan, People's Bank of China. Remember, these were emergency operations. The fact that they printed $14 trillion was an emergency operation, central banks globally. The fact that the Federal Reserve took their monetary base from $800 billion to $4.5 trillion was a temporary condition. In other words, we are going to someday, when the emergency was over, but by the way, the emergency took many more years than they promised it would be. But when the emergency ended, they were going to reverse course and sell those assets back to the public and take those dollars out of the economy, take those reserves off the banking system. But a funny thing happened on the way to doing that. The global economy imploded. So here's the point now. The Fed is now admitted, and this is why you should have no faith in central banks. The central banks now have admitted, tacitly at least, that they can never take away those assets. They can never drain their balance sheet, meaning they have permanently monetized this debt. Another way of saying that is that interest rates, nominally speaking, can never be allowed to rise above zero in nominal terms, and in real terms will grow more and more profoundly negative. That should shock investors. That's a moment of enlightenment, a watershed moment, an epiphany throughout the world. Hello, investors. Central banks are putting you on notice, saying that nominal interest rates are going to be at zero or below, and real interest rates will grow more and more negative throughout time.
What knocks the bond market off? You wrote a book, 2013, about the coming bond market a bubble, the destruction of the bond market, or the bond market bubble is going to blow up. You wrote a book about their expert in it.
Coming bond market collapse.
That's right. What happened if they have permanently reduced interest rates? Do they let the bond market collapse? Do they try to put it in suspended animation? Do bond vigilantes of old come back in and raise interest rates? How does the bond market collapse?
So here's where I see happening. It'll take a little time to lay this out for you, but if you remember back in April or May of 2018, I came on your program and I said to your audience, I said that beware of the fall. Find the nearest emergency exit as soon as possible. Because I realized that central banks, globally speaking, were starting to reverse monetary policy.
You did.
And unlike what central bankers were telling you, this was a very pernicious, deflationary, depressionary process. And right on time, right on schedule, October, November, December, the entire global economy and asset prices, stock markets started to implode. They lost, Shanghai Composite Index, look at the Bank of Japan, what they were doing, and look at the monetary policy there, stuck at zero forever, even though their market peaked in 1989. European stocks fell precipitously. So I knew this was going to happen. But I told you that it was going to last longer than even I thought it was going to last. Because what happened was in January and so far in February was a V-shaped recovery in stock prices. So what changed? Let's go through the process of what changed. So central banks were very hawkish, causing the economy to implode, and now they've turned slightly more dovish. But unlike what CNBC will tell you, this has very little to do with a trade war. So CNBC says that a temporary truce in the trade war is the reason why stocks have rebounded. The reason why a trade war is pernicious to global growth is that trade contracts. Okay, we all can agree on with that. Just like what happened with Smoot-Hawley in 1930. So tariffs retard global trade, and that's why it dampens global GDP. But that's not what happened in 2018. What happened in 2018 was because of the way the trade tariffs were constructed, they were constructed to go up in January of 2019 from 10% to 25%. So there was a lot of front running of these tariffs. So global trade actually increased in 2018. So exports from the U.S. to China rose by 0.7%, and exports from China to the United States actually increased over 11%. So this is not about global trade. It's about two things. Can China, which was responsible for 1/3 of the global growth coming out of the Great Recession, can China cause their economy to rebound sharply, even though it's debt disabled? They had $7 trillion in debt in 2008. They have $40 trillion worth of debt today.
Wow.
That was 160% of GDP, debt to GDP in China, 160%. In 2008, it's now 304% of their GDP. So China really is debt disabled. The fact that they are now pushing money, they're pushing the People's Bank of China to push money to the state-owned enterprises to boost their growth. I mean, at best, you might get a month or two of a rebound in their economy, but it certainly can no longer produce viable growth because it's a debt-disabled economy with a 40 trillion pile of unproductive debt dump. So take China off that, take global trade off the burner. The only thing we have left is, and here's what I'm struggling with today, to be honest with you, because I can be wrong. Unlike central bankers, I can be wrong. You know, unlike these demigods that are always correct and have the ability to pick the interest rate, the exact price of money forever, and they have given themselves that power, unelected power, I might add. So can central bankers turn around the global economic business cycle, which is clearly turned to the downside? And I'll have more data on that in a second. And the answer to that is probably no. That's my base case scenario, because let's look around the world. The Bank of Japan is at negative interest rates. Overnight lending rate in Japan is negative, and they never got out of QE. The ECB, the European Central Bank, also has a negative discount rate, okay? And they were only able to end quantitative easing in December, okay? And then the Federal Reserve, they do have 50 basis points in which to lower interest rates, but they've already admitted that they can never drain the balance sheet more than another couple $100 billion. So how much credit, how much credence can you give central bankers to turn the economy around when in 2008 they had hundreds of basis points, 525 basis points to turn the economy around on the part of the Federal Reserve. And their central bank, the Central Bank of the United States, had plenty of room, plenty of overhead to expand its balance sheet. And they did. They printed $3.7 trillion. And the same thing can be said for the ECB. So these central banks don't have the leverage. They don't have the means to automatically turn around asset prices. You know, don't forget, in 2007, our Federal Reserve first began to lower interest rates in the summer of 2007. That was a miserable time to buy stocks. So if it's not about trade, if China can't re-leverage its economy into spectacular growth, and central banks are extremely hampered, extremely fettered with their ability and their means to which to stimulate economic growth immediately, I would be cautious about buying this rally, which is what I am. I think we're going to have one more sharp downturn in the equity market, for which I will cover my shorts. And then, Greg, here's the sad truth. You have to go massively long inflation hedges. You know, and I want to just add this before I forget. Jerome Powell is doing what they used to call Humphrey Hawkins testimony today before the Senate, and he's he's actually ruminating, about making inflation a so-called a makeup period for inflation. So inflation was coming out of the Great Recession sub 2%, which is this magical rate of inflation, as if you and I were suffering and your audience was suffering under an inflation rate that was just 1% or close to 0%. But it was below 2%, that magical number, for many years. So I went back and looked up on the BLS how many actual years did the year-over-year rate of inflation, the way they measure it, fall below 2%. It was 7 years. So now Jerome Powell is ruminating, him and this merry band of money printers are ruminating, making inflation more than 2% for the same period of time that it was below 2%, which is 7 years. Now, if these individuals, these demigods, start printing money, enough money to make sure inflation, the way they measure it, is above 2%, well, my God. I mean, you're talking about an evisceration of middle class. You're talking about the gap between the wealth and the poor blowing out significantly, even more. So people who own the top 1% of the economy, that own most of the world's the U.S. Asset prices, home prices, and stock prices, they're going to get richer and richer. The bottom, half of the population, which spends most of their money on food, fuel, and energy, are going to get wiped out. But these demigods don't care. They're only there for one purpose: to make sure the assets that banks own never go down. So real estate prices can never fall. Stock prices can never go down for any kind of extended period of time. So they'll do whatever they can to do what, Greg? Save the banking system and protect the elites in this country until we have a plutocracy. And as you know, and you're a student of history, a very smart man, economies and countries that do not have a viable middle class cannot and never last.
They're never paying that back. Right? I mean, they're never. To your point, they've permanently monetized the debt, which should be pretty frightening for people. That the jig's up. We can't take it back, and so they're not going to pay this money back. Nobody is. Europe's not going to pay it back. Japan's not going to pay it back. Argentina, China, nobody's paying this money back, which stunning number with China.
That's the only way the global economy can exist. It's the only way the global economy can function, because as I already laid out to you, asset prices and the economy have become one. The only way these asset prices can maintain their bubble-like status is if central banks permanently monetize all that debt, leave the money supply, the base money supply, which is the most important metric that nobody really talks about on the mainstream financial media, but you allow people to explain. Base money supply is the basis for all lending. They're leaving all of those reserves in the banking system. So interest rates will always be near zero. In real terms, will be profoundly negative. And asset prices and bank lending and money supply will grow in perpetuity. This is the stuff that makes banana republics blush. If you think about Weimar Germany, or you think about Zimbabwe or Hungary, these countries printed equivalent of inflation adjusted trillions of dollars, and they had no method of taking that money out of the system, and those individual currencies collapsed, causing hyperinflation. Well, we did the same thing here. Globally, we printed $15 trillion, and that money now, investors should understand that money is in the system permanently, meaning, again, that's going to make money supply boom and keep asset prices inflated until we get hyperinflation, and then that's the big key. If I'm correct, and even in Rome, when there was only one primary global currency, Rome had 1,000% inflation. So they had intractable inflation in Rome. So don't tell me that investors say, well, people will always have faith in the euro and the Japan and the US dollar. So maybe the dollar won't collapse against the yen. I might have sympathy with that argument. But these currencies will collapse against precious metals, as they did in Rome. Prices will grow inexorably higher. as they did in Rome, as when there was one global currency that wasn't measured against other. People in Rome every day didn't measure their denarii against, another civilization that they didn't even know really existed. There wasn't that kind of trade dependency on, quoting an exchange rate on a daily basis. So when you lose faith in currency's purchasing power, which is what they have told you, they put you on warning, which is why gold has had a spectacular 3-month rally, and I think it continues after this period of consolidation. They have told you that interest rates can never and they will never be allowed to rise, and they have no ability to take away those reserves from the banking system. The debt has been permanently monetized across the globe. That's pretty scary, Greg. If we're all headed to the same direction as Rome, it's pretty frightening.
Do they default like Puerto Rico and say we're not paying you, or do they default like?
Can't do that.
So they're going to default how are they going to default?
So they started to go down the road of explicit default, which in other words, they started to normalize interest rates. They said, hey, let's take away this process of quantitative easing and let's go into quantitative tightening. Even the ECB was going down that road. They never even tried it in Japan. But that leads to a process of a deflationary bust in the economy, a deflationary depression, if I can be so explicit. And that's off the table because, think about the public pension system where it's $4 trillion of unfunded liabilities, or the $9 trillion in corporate credit that ballooned from $6 trillion from 2008, or the auto loan market, which is over $1 trillion, or the credit card market, which is over $1 trillion. Auto loans, by the way, there's 7 million of these auto loans now that are in arrears. So what happened was when you drain those assets, what happens? You enter into an economic contraction, a deflationary one that's marked by deflation, and then all of your obligations begin to be defaulted upon. So you get a crash in the stock market and a crash in the economy and massive defaults. In other words, there won't be a public or private pension plan that remains solvent in the entire globe. They can't stand there. The central banks have gone on record saying if you read between the lines, they messed up, for the lack of a better word. They understand now that they control the entire global economy. They control all asset prices, and they can never step away. That should scare everybody, Greg, because let's think quickly down the road what's going to happen, because these central bankers don't play chess very well at all. So by admitting now that you can never raise interest rates, you can never drain those assets, nominal interest rates are stuck at zero, and then eventually you're going to get that inflation going full speed. In fact, that's what they want. And the central banks have no ability to keep inflation at 2%. We shouldn't trust these people at all, especially the way they measure inflation, under measuring it chronically. So once you do generate that intractable rate of inflation, then you're going to get a blow up in the bond market. In other words, every fixed income instrument, think sovereign debt bond, that isn't directly being controlled and purchased by the central bank, those interest rates are going to skyrocket. Think about high yield debt. So that's what they're not think. That's what they have not thought through thoroughly. What happens when they generate inflation, and then at that point, don't forget, asset prices will be even more grossly separated from the underlying economy. They're now 140% total market cap of equities, 140% of GDP. That's 90 percentage points above the average, going back from the 70s, 80s, and 90s. Okay, that divergence is going to grow even more trenchant. So when is it going to be a good time for them to actually normalize interest rates? After they created all this inflation? After asset prices become even more unglued from the underlying economy? No. So we're headed for a inflationary, destructive implosion of the economy that probably will be followed by a deflationary collapse of the economy once they finally admit, and this is going to be only after the middle class is in revolt. So this is a long time away, but they're going to have to admit finally, hey, we need a complete currency reset. So we forgive all the debt and we get a new currency, globally speaking, which will probably be some kind of crypto coin, a government managed crypto coin. But that's years away. We are now at the tail end of that period of deflation that I warned about, this period of global stagnation and recession / depression. That's going to probably consummate in the first few quarters of this year. And then we're headed for this long period of rapid runaway inflation for which there is no escape.
Yeah, is this why gold is going up? Can you talk about gold a little bit? Gold and silver. Is this why gold and silver are going up?
Well, that's exactly why. Precious metals are one of the last bastions of the free market where individuals are allowed to protect their purchasing power. You know, if we're headed for a scenario where interest rates are negative in the banking system, so you put a deposit in the banking system and it becomes negative, so you're guaranteed to lose money in nominal terms, Greg. And in addition to that, you're going to lose much more when you adjust for inflation. Where is your protection? Especially if we go into this regime of cryptocurrencies where you cannot take money out of a bank. You either can leave it there and lose money or spend it, getting that velocity up and increasing inflation. I mean, this is a scary world. And can I just step back for a second? Because I know there's got to be somebody out there saying, oh, gee, this is a Cassandra. This is like gloom and doom, blah, 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 blah. Let me ask you a question. If that's you out there, ask yourself this question. And if you're of any age, above 30 or 40 years old, did you ever imagine that a major central banks, not major central banks around the world would have nominal rates at 0% and negative and leave them there for years and be unable to get away with raising them even a little bit? Did you ever imagine that central banks around the world would print trillions and trillions of dollars and never be able to drain those funds out of the banking system? Did you ever imagine that asset prices would never be allowed to fall? Ever? Not even for a small, truncated period of time? This is a new world we live in. And it's a scary world. And if I'm right, and I'm very much convinced that I am, and central banks have no choice now but to print money, go back after this next deflationary, depressionary collapse in the global economy consummates, they have no choice but to go back to perpetual QE and negative rates. And let me just add this real quick. You'll have a huge switch, a huge move to the left. And I say left, I'll say to a move towards socialism and communism throughout the world. So autocracies, plutocracies, socialism and communism. Don't you see that here, Mr. Doubter? Don't you see the move here towards universal basic income and going from a meritocracy, which this great country once was? You have a president of the United States who not is a lover of debt, but at least he espouses to be a capitalist. When he gives a State of the Union address, the Democratic Party can no longer stand up and applaud the fact that we're still a capitalist nation. Where are we going here? I mean, you might call me a Cassandra and that this is a scare tactic, but I'm here to make money for my clients. Whichever way we go, deflation, inflation, or a sense of normalcy. But I'll tell you this, trailing 12-month earnings on the S&P 500 are 17.5 times. This is occurring in the context of negative earnings growth and peak margins. So if I'm right and the global economy has peaked and there isn't any way to easily remedy the business cycle from imploding because central banks are primarily out of most of their bullets, all they have left is more QE, then don't you think you have at least the common sense to be cautious here and garner yourself with some protection with gold, silver, precious metals, and an active management strategy that gives you the potential to capture the moves both up and down in the stock market? Doesn't that make sense? I think it does.
Yeah, you think the next move is decidedly down?
Well, listen, this is my opinion. I believe, as I've clearly reiterated on your program, on your show, that the business cycle is falling. we have in an out-and-out recession in Italy. Global PMIs are crashing. German growth is zero, a big fat goose egg. Year-over-year growth in Japan is 0%. You look at core capital goods here in the United States, a minus sign. Retail sales, the lowest in 9 years, down 1.2%. New home sales plunged. New home sales this morning were what? They were down 10.2% year over year. I'm trying to remember so much data. Existing home sales were also down. So we have all this bad data here in the United States. If you look at the global PMIs, as I say, they're crashing. You've got a recession in throughout most of Europe, or at least the core of Europe is stagnating, and also in Japan. China is struggling just to print money like mad, just to maintain their, ersatz 6% GDP growth. But they're never going back to a robust rate of growth, not for a very long time. So I think the business cycle has turned, and the tools left to get us out of this recession are greatly and vastly diminished. As I said, it normally takes 500 basis points to get the economy out from its recessionary tailspin. We only have 240 basis points here in the United States. They've got nothing in Japan, and they've got nothing in Europe.
Would they have to ditch the dollar? I mean, we had this, you keep hearing even Christine Lagarde, IMF, all these people say we're going to have to reset, we're going to have a reset. This is not something just talked about by me. It's most of the big central banks, the IMF, Christine Lagarde at the IMF, International Monetary Fund. Could Donald Trump turn the table over and say, we're going to have a new dollar. We're going to have a treasury dollar. We're gonna keep the Federal Reserve note, but we're going to have a treasury dollar. And could he save the day by changing the currency, or is that just crazy time?
Well, I don't know if you could say. I mean, I have my doubts he can save the day. I mean, you're talking about a global currency that's going to save the day. This is a global cryptocurrency that is going to be used to make sure that you cannot make a run on the banking system. So you're talking about a global currency. It could be maybe we have competing cryptocurrencies, but it'll be a state-run cryptocurrency that ensures that you cannot go to the banking system and say, hey, I want my deposits back. And if you do that, and this is not my opinion, it's a fact, if you take your deposits out of the banking system because you're losing money in nominal terms on an interest rate, banks go insolvent. It's a run on the bank. They have to liquidate their assets to raise more money. There's not the money out there. Asset prices plunge, and the economy goes into a deflationary, chaotic tailspin. So they have to go into a cryptocurrency. And I don't think Trump, unfortunately, I don't think Trump can save the day on that front. I don't think China can save the day either. People worry about China being the growth engine, like they were coming out of the Great Recession. It might surprise your listeners to learn that. So you have two inputs to GDP. One is labor force growth. The other is productivity. Labor force growth in China is negative. They have a shrinking labor force growth. Their one-child population disaster is coming to bite them in the rear end. They don't have a labor force growth at all. It's shrinking. And their productivity rates have been halved coming out of the Great Recession. So there is no rescue coming from the debt-disabled nation of China. And I don't think, as I clearly laid out, central banks around the world don't have the firepower to turn around the economy immediately. So we're going to have, in my opinion, my base case, but I'm modeling the dynamics, we're going to have one final whoosh down in stock prices and in the economy. That's going to bring Jerome Powell back to zero, back into QE like the rest of the world's central banks. And then it's intractable inflation for as far as the eye can see. And that's going to be a very, very dangerous new paradigm for the world, because we're all going to look like Rome. And Rome had 1,000%. Rome at its apex of inflation had 1,000% rate of inflation. Now, maybe I'm wrong. Maybe it's only going to be double digits. Maybe it'll be something much worse in the 70s. But that was not a good time for anybody in this country. And I think it gets much, much worse because the dynamics have all changed. Back in the 70s, we didn't have 0% interest rates. We didn't have a monetary base at $4.5 trillion. We didn't have a $22 trillion national debt. We didn't have 330 40% total debt to GDP. We didn't have an insolvent pension plan system. So, I mean, you guys take your chances out there if you want to without any protection, but I would encourage your listeners to get yourself an active investment manager and seek some protection in physical precious metals, at least 5%, and then have the balance of your allocation depend upon the macroeconomic environment, whether it be deflation or inflation.
Michael Pento, good advice. There'll be a lot of people who go, 5%? What? I'm going to go higher than that. I mean, you got Mike Greer says that some of his clients he vaults gold for.
I'm at 7. The portfolio now is at 17 to 20%.
Physical.
Yeah, I have never been that high before.
Wow.
And that is precisely because what I laid out to you is that gold hates rising nominal interest rates because gold does not pay interest. Gold hates rising real interest rates, but interest rates are zero. They're staying there for a very long time. They're headed even lower here in the United States from 2.4 back to zero. They're zero already and even negative around the world. And because we're headed towards a situation where the central banks are going to have to make up for those lost periods of times when inflation was, God forbid, below 2%, real interest rates will be falling profusely, and that's rocket fuel for gold, regardless of what the currency does against the dollar does against the euro or the Japanese yen.
Michael Pento, thanks for joining us today. You killed it. Thank you for joining us today on usawatchdog.com. I'll put the links up to pentoport.com, your website. You have free stuff. You have a podcast. Of course, you manage money for people, but you write a lot of stuff. You just wrote a thing about, you use some of the stuff in your thing about the Repo Man's Valentine's Day present. We talked about all, the car loan delinquency rate, 90 days behind. People are behind, and all the other terrible numbers, some of the numbers you brought up here today. You write a lot of free stuff. You're a good man. Thank you for coming on and giving us, what your views on where we're going to be heading in the next few months, in the next few years. Thank you, Michael Pento of pentoport.com, Pento Portfolio Strategies. Thank you for joining us today on usawatchdog.com.
My great pleasure, Greg.